Okay, then go back to this example. Denny Associates has built up a 4-year contract to supply the computing requirements from or for a local bank. We do have this information about the project, let's say. We do have a project and we are thinking about computer equipment to be added to the company. So we do have $250,000, the cost of computer equipment. The working capital required for the project, which means the operating activities need some money. So the working capital required 20,000 for the project, 20,000. Upgrading the equipment in 2 years means after 2 years, I need to update my equipment. After 2 years, which means one time, not 2 times. In year 2 or in 2 years, which means after the second year. Salvage value of equipment in 4 years. If you remember the salvage value, which is the market price of the asset at the end of the life, and will be received after 4 years for one time, 10,000. And the annual net cash flows or inflows, 120,000. So I'm expecting to receive 120,000 as a net cash inflows for the company. Working capital will be released at the end of the contract. The 20,000 will be come back after the 4 years or after the life of the project. And the discount rate or interest rate will be 14%. This number is used for the tables, if you remember. So the question is, what is the net present value of the contract with a local bank? To calculate that net present value, we need to draw a table. The table contains the components that I'm discussing, years or the time that I'm paying or receiving this amount, the cash flows, the amount, the factor which is or which comes from the tables, either table number 1 or table number 2, and the present value, which is the answer. Now, the investment in the equipment, I'm paying 250,000 now. I'm paying 250,000 now. So between brackets, 250,000. The word now means no time of the period will be 0. The period will be 0. So the factor will be 1. Okay. No factor because no time of money. The time of money referring to now, which means the factor will be 1. So 250,000 multiplied by 1 equals 250. The working capital needed, I need to pay 20,000 now, and also the factor will be 1, and the answer will be 20,000. Annual net cash inflows, I'm receiving or I'm expecting to receive the cash flows from year 1 to year 4. So I'm receiving 4 times 120,000. Okay. At the end of each year, I will receive 120,000. The point is here, the factor using table number 2, not 1, because I'm talking about annuity. If I'm talking about annuity, which means more than one amount to be received, more than one amount to be received during the years, then I will use table number 2. Table number 2 talking about annuity, which means more than one amount to be received. So 1 to 4 means I'm receiving from year 1 to year 4, 120,000 each year, multiplied by the factor, and this will be the conjunction between 4 years and 14%. So I will have 2.914 and multiplied by 120,000, this equals 349,000 something. So this is the present value. This is the word. This is the present value of 120,000 to be received 4 times. Okay. The total amount, if you like, for the 120,000 for 4 times how much? For 80,000, is it? For 80,000. The 120,000 multiplied by 4. The total amount will be for 80,000. But the present value means the time or the amount of the 124 times today will be 349 instead of the total amount. Upgrading the equipment in year 2, which means I will pay the 90,000 one time at the end of year 2, multiply by a factor, and this factor comes from table 1. Why? Because I'm talking about one amount to be received once, multiplied by 0.76. This equals to 69 something. So again, the present value of the 90,000, the present value will be paid after 4 years, but the present value today for the 90,000 is 69,000. I'm trying again to calculate the present value of the project today. Okay, so 69 will be the present value of the 90. Salvage value of the equipment will be received one time after 4 years. So 10,000 multiplied by a factor from table 1, this equals to 5,920. Again, the present value of the 10,000 today is 5,920, not 10,000. I will receive the 10,000 after 4 years, but the present value today is 5,000 something. Okay. Working capital is released after 4 years. I will receive the 20,000, but the present value will be 11,840. So the total for the net present value will be 28,230. This will be the present value of the project. If we have a present value of positive, means I will accept the project, and then the answer is 28,230. The decision is accepting the project. Why? Because we have a positive net present value. Yes, net present value. Okay, another way to calculate the net present value, if the company offered a 5-year contract to provide the components parts for a large manufacturer. We do have 5 years. Costs of the equipment 160,000, working capital 100, relining equipment in 3 years, which means after 3 years I will pay one time. Salvage value 5 years, annual cash revenues and costs 750, 400, 270. I need to calculate the net present value here, and the discount rate is 11%. We have to draw a table. The investment now 160 multiplied by 160. Since the investments in equipment 160 and the working capital is 100 occur immediately, which means now the factor will be 1 because no time of value. Now, in this case, the answer for the net present value can be in this way. Why? Instead of using table number 2, I will use table number 1 only. If we do have any changes in the cash flows, look at these annual cash inflows, it is not equal. So in year 3, I'm receiving 50 instead of 80, which means I cannot use the annuity. Annuity means the same amount to be received every year. Suppose that we don't have an equal inflows for the 5 years. 1 year, I will receive 50 only because any reason, any circumstances happen in year 3 that entitle the company to receive 50 instead of 80, which means I will use, look at here, I will use the factors from table 1. Why? Because the amounts are not equal. Okay, so this is another way to solve the question, and the net present value will be what? The net present value will be 76,000 something. Inflow 1, 2, 4, 5 same. Yes. In this case, we can use the annuity for 2 years. So instead of 2 factors for year 1 and 2, I can use 1 factor. Yes. 4, 5 also I can use 1 factor, but it will be 11% with 2 only, 2 periods, right? Okay. So the net present value in this case will be $76,015, which means I will accept the project because we do have a positive income a positive net present value, a positive net present value. Once you have computed the net present value, a positive net present value indicates that the project return is bigger than the discount rate of return, and the negative net present value, which means less than the discount rate, which means if it is a positive, I will accept. If it is negative, I will reject. If it is zero, zero means what? Zero means the rate of return comes from the project is exactly equal to the discount rate. In other ways, if you put your money in a bank, they will give me the 11%. If I put it in the project, I will have the 11%. Okay? In this case, it depends on the company actually. If the company's cost of capital is usually regarded as the minimum required rate of return, which is the minimum required return for the company, the cost of capital is average rate of return the company must pay for its long-term creditors and stakeholders. This is called the cost of capital, or in another way, the required rate of return by the company. Much better for the word. The net present value method automatically provides a return of the original investment. Suppose that we do have this example. We do have a cost for a machine, 3,169, life is 4 years, no salvage value, and the increase in annual cash inflows 1,000. Annual rate of return is 10%, or the criteria for the company, the investment are to be made unless they have an annual rate of return is 10%. 10% then is the required rate of return by the company. Will be allowed to invest in this investment or not? We have to calculate the present value. Calculation of the present value, again, the initial investments, which is outflow, I will pay now 3,169, multiply by 1 because no time. The annual cash inflows, again, we can use it 4 times using table number 1, or 1 to 4 using table number 2. So these factors comes from table 1, or if it is equal, the cash flows are same, we can use table 2, and we do have a new factor. So the total of the net present value in this case is 0. 0 means what? The present value is 0 means it depends on the company. This implies that the cash inflows are sufficient to recover the initial investment and to provide exactly 10%. The required rate of return by the company is 10,000, is 10%. Okay? The project will give you exactly 10%, which means it depends on the company. It depends on the company. Let's do an exercise for the net present value. Exercise 14.2. 14.2. The management of Kankale Company is considering the purchase of 27,000 machines that would reduce operating costs by 7% per year. At the end of the machine's 5 years of useful life, it will have a 0 salvage value. The company's required rate of return is 12%. What is the initial cost? It is 27. What is the net cash flows? Net cash flows can be referred to the deduction or reduction of the costs. So we do have a reduction in the operating cost by 7,000. This can be a net cash inflows. So determine the present value of the investment in the machine. Any idea? The 27, we need a table, is it? The 27, the initial cost of the machine, 27,000, multiply by 1. Why? Because no time. So multiply by 1, right? The initial cost in number 2. Determine the net present value of the investment in the machine, What is the difference between the total undiscounted cash inflows and cash outflows over the entire life of the machine? Okay, first we need to calculate the net present value. Net present value. Look, the 27 is multiplied by 1, so 27. The reduction in the operating costs, we are saving how many times? We are saving the 7,000 every year. So we use it for 5 years. So the 7,000 will be saved, which means it is a net cash inflows for 5 times. So we need a factor from table 2. Table 2. The conjunction between what? 12% and what? 12% and 5 years. 12% is here. If you use the table, so we need to look at 12% and 5 years, table number 2. So the factor will be 3.605. 3605. So 7,000 multiplied by 3.605. This equals to 25,235. These are net profit or net cash inflows. Net cash inflows to be saved during the 5 years, and we do have already 27,000 to be paid once. So what is the net present value? If you like, you can draw the table in another way to say 27,000 negative multiplied by 1 time or factor. So this will be 27,000, is it? Right? And the 7,000 this year 1, this from 1 to 5. So we need a factor 3.605. This equal to 25,235. So the net present value, no salvage value, by the way, right? No salvage value. So the net present value will be 1,765 negative. Negative means what? The initial cost is bigger than the savings of the costs or the net cash inflows. So it will be rejected. Why? Because we do have a negative net present value. Negative net present value. Any question for this? Any question? We can draw it in this way, okay? If you like. So we need the year, here the investment, here is the cash flows. So year, amount, and factor, and the net present value, okay? So we can draw it exactly like this table, okay? So we do have a negative net present value, which means we will reject the project. We will reject the project. Okay. Number 2, what is the difference between the total undiscounted cash inflows and the cash outflows over the entire life of the machine? What do you mean by 7,000 multiplied by 5? 7,000 multiplied by 5 is equal to $35,000, is it? $35,000. I will receive 7,000 for 5 years. So the total amount will be 35,000, is it? 35,000. But now it is not equal to 35,000. This is the word of the present value. We will receive 7,000 for the next 5 years. But actually today it equals to less than 35,000. That's why we need to consider it for the present value factors, okay? So if we say 35, if we depend on 35, which means no any inflation, and the 35 for the next 5 years is equal to 35 today. This is number 2. So the total cost savings, if we don't consider the time value, will equals to 35. And we will compare it to the initial investment 7,000. So we do have a positive net cash flows for 8,000. Now, if you don't consider the difference between and 1 and 2, if you don't consider the time concern, which means you have to accept the project. Why? Because the project will give me 35,000 for the next 5 years, is it? And I'm paying now 27,000. So I do have a net cash flows for 8,000. But actually, because of the inflation, the 35,000 for the next 5 years is not equal today the same amount. It equals to only 25,235, depending on the factors or the time factors. Okay. Any question for that? Then objective number 3, evaluate the accessibility of the investment project using the internal rate of return method. Internal rate of return method. Internal rate of return method is the rate of return promised by the investment project over its useful life, which is the 12 or the 11 or the required rate of return, same. It is computed by finding the discount rate that will cause the net present value of the project to be 0. It works very well if the project cash flow are identical every year. If the annual cash flows are not identical, the trial and error process must be used to find the internal rate of return. Example. Again, the general rule, if we accept a minimum required of return, rate of return, if we have this amount or percentage, then we will accept, otherwise we will reject. Decker Company can purchase a new machine at a cost of $104,320. That will save $20,000 per year in cash operating costs. Again, the saving in our costs are referred to what? Saving in our costs refers to cash flows. Cash flows. The machine has a 10-year life. 10-year life. The rate of return simply, future cash flows are the same every year in this example. We can calculate the internal rate of return by the present value factor for the internal rate of return is equal to what? Investment required divided by the annual net cash flows. If you remember this word, we discussed this formula for what? For the payback period, is it? Payback period. We use the same formula for the payback period, right? The investment required divided by the net cash flows. Now, the initial investments in 104,320 divided by the annual net cash inflows 20,000, this equals to 5.216. Now, this number, which is a little bit hard, this number should be found in the tables in order to know the return or rate of return, which is the opposite of the net present value. Now, the number that we calculate should be extracted from the tables. So the table, if you will look to the table, for the 10 periods given in the question, now the 5216 will be found in or under the 14%. So the 14% will be the internal rate of return. For our example, for the net present value, we give you the internal rate of return or the required rate of return is 14. And then we found the factor in order to calculate the net present value. So it is the opposite, if you like, for the net present value, which is not so important because we have to use the table. So if the company minimum required rate of return is 14, less than 14 is rejected, more than 14 will be accepted. Okay. An example for two alternatives for the net present value. White Company has two alternatives. Remodel an old car wash or remove the old car wash and install a new one. The company uses a discount rate of 10%. We do have this information for two projects. Annual revenues for the first project is 90. For the old car wash 70,000. Annual cash operating costs 30,000 for the new car wash or 25,000 for the old car wash. Annual net cash inflows 60,000 for new car wash, 45,000 for the old car wash. What is the difference for if we have more than one alternative for the net present value? We have to calculate the net present value for each project and then decide. Now, we do have, if the company installs a new washer, car wash, the cost will be 300,000. By the way, the previous information is about the net cash inflows, which is one item for the calculation of the net present value. Now, if we install the new car wash, the cost will be 300,000, 10 years. Salvage value for this machine will be 7,000. Replace brushes at the end of 6 years, which means how many times? One time. We replace brushes at the end of 6 years, which means we will make, let's say, maintenance for our machine one time after year 6 for 50,000. The salvage value of the old equipment will be 40,000. What is the net present value of this alternative or for these two alternatives? We need to use the factors. Okay? So these are the factors, the tables, and these are the summary. The first table will be the table number 1. The second table for the annuity. Okay? For the questions or the exam or any exercise should be given. The factors should be given. Now, look at the presentation or the calculation for the present value. Install a new car wash. We have an initial investment for 300,000. The factor is 1 because we are paying now. So 300,000. Replace brushes in year 6, which means one time, 50,000 to be paid after year 6 using table number 1 because one time. So the value or the present value of the 50,000 to be paid after year 6 today is 28,200. Annual net cash inflows 1 to 10, 60,000 multiplied by factor 6145. This equals to 368 something. Salvage value of the old equipment. If, by the way, we are calculating the present value for each alternative. If we install a new machine, then we can sell the old machine, which is the salvage value to be sold when? Now. Why? Because we install a new machine, so we can sell the old machine now. So the salvage value of the old machine, the time is now, or the year is now. So 40,000 multiplied by 1, the salvage value of the old should be sold now if we install the new machine, so 40,000. Salvage value of the new equipment will be sold after 10 years. So at the end of the 10 years, 7,000 multiplied by a factor from table 1. So this equals to 2702. The net present value of the new machine will be 83,000 something. If we install the new machine, the investment is yield a positive net present value of $83,202. Now, compare this number with the remodeling or updating the existing washer. If we update, let's say, instead of buying a new machine, we will update the old machine. If we're remodeling the old machine, this will cost 175,000, and we need to replace the brushes at the end of year 6 for 80,000. So the net present value in this case will be 175,000 to be paid now. The brushes at the end of year 6 multiplied by 0.564 comes from table 1, right? 45 something. Annual net cash inflows for the old machine, which is the current machine, 45,000 from 1 to 10, multiplied by factor from table 2. So the net present value will be 56 something. Now you have two present values, net present values for two projects. What is your decision? What is your decision? To what? To choose the bigger, right? The higher net present value. So both projects are positive net present value, but we have to choose the higher net present value. So we do have a difference in favor for the new washer, 26,000. If we install the new machine, we will have a net present value bigger than updating the old one. So same. In other ways, we will have to recalculate or calculate the net present value for the two products or projects, and we have to choose the higher. In decisions where revenues are not directly involved, managers should choose the alternative that has at least or the least total cost from the present value perspective. Okay. A company is trying to decide whether to overhaul an old delivery. Overhaul means overhaul. This word is related to cars. Overhaul. Updating, let's say, upgrading. If you do an overhaul for your car, means you are maintaining the engine. Overhaul an old delivery truck now or purchase a new one. Okay. The discount rate is 10%. And we do have two information for two products or projects. Old truck overhaul cost now 4,500. Annual operating cost is 10,000. Salvage is 250. Salvage value now is 9,000, which means what? Why we do have two salvage values? If we install a new one, then we can sell the salvage value now for 9,000. If we wait until the end of that life, the old one, we have to use the 250 only. The new truck, the purchase price is 21. Annual operating cost 6. Salvage value in 5 years is 3,000. Same. Look, we have to calculate the two present values. Okay, the only difference here, we do have two negative net present value. We do have two projects, but both have negative net present value. What is your decision then? Yes. In this case, the first, or buying a new truck, will have a net present value 32,000 and negative net present value. But if we keep the old truck, we will have a negative net present value for 42,000. So our decision should be to go for the first option. Why? Because it will be more profitable. So the decision, the net present value of costs associated with the purchase, 32,000 for the new truck, negative, but 42,000 negative for the existing truck. So the net present value in favor of purchasing a new truck is 9,372. By the way, we're talking about costs here, costs, okay? Learning objective number 5. Learning objective number 5. Rank investment project in order of preference. Internal rate of return method. When using the internal rate of return method to rank, what does the rank means? Yes, which is the best project, and then which is the next best project. When using the internal rate of return method to rank competing investment project, the preference rule is the higher internal rate of return, the more desirable project. The net present value of one project cannot be directly compared to the net present value of another project unless the investments are equal, definitely. If the investment is not equal, if the investments are not equal for two options, I cannot decide for the net present value if it is positive or negative. Look at this example. We do have a net present value for project A, 1,000. For project B, 1,000. But the investments required for project A is 10,000. For project B is 5,000. So can we depend on the net present value? No, because the investments are not equal in this case. So we will have or use something called profitability index. Profitability index. This is a very simple topic. Net present value of the project, net present value of the project divided by the investment required. So the net present value for A is 1,000 divided by the investment required 10,000. This equal to 10%, 0.1. For project B, we will say 1,000 divided by 5,000. So this equals to 20%. So I will choose what? B. Why? Because the profitability index is bigger. Again, we cannot decide for the net present value for this decision. Why? Because the investments are not equal. We use the net present value if the investments are equal for two projects. Okay, so the higher net present value, the better. In this case, we cannot use the net present value. We will use something called the profitability index, which is simply net present value divided by the investment. In this case, the higher the profitability index, the better project. The last thing, compute the simple rate of return for investment. Simple rate of return is calculated annual incremental net operating income divided by the initial investment. And the investment should be reduced by any salvage from the sale of all the equipment. Example, management of Daily Grid wants to install an espresso bar for its restaurant. The cost is 140,000, 10 years, will generate incremental revenues for 100,000 and incremental expenses for 65,000, including depreciation. What is the simple rate of return for the investments? Go back to the formula. Annual incremental net operating income. What is the net operating income means? Net operating income or net income, revenues minus expenses. The word incremental, addition. So we do have 100,000 here, 100,000, 100,000 in revenues and 65,000 in expenses. So what is the incremental net profit? 35, 100 minus 65. So we do have a simple rate of return by the incremental net profit, 35, divided by the investments, which is 140,000. This is called simple rate of return for 25%. But it ignores, again, the time value of money. And also the same project may appear desirable in some years and undesirable in other years, which means the time is not important. That's all. Thank you.